Okay, let's just dive right in. If you run a business, any kind of business, you know the reality. Sometimes you lose money.
It happens, even to the giants.
Exactly. Startups, established companies. I mean, think about FedEx or Amazon in their early days. Years of losses sometimes. It's just part of the deal.
It really is, the ups and downs.
And when you're in the red, looking at those negative numbers, the last thing you probably feel like doing is thinking about taxes. It feels bad enough.
Like salt in the wound.
Does the tax system just leave you there? Or maybe is there something built in, like a lifeline, to give you some relief when you've had a rough year?
And that's the fascinating part. The system does acknowledge that volatility. It gets that one bad year isn't the whole story.
Right. And that lifeline we're talking about today is the net operating loss, the NOL. Sounds technical, I know.
It does, but it's crucial.
Absolutely crucial if you're an individual taxpayer with business losses, an estate, a trust, or especially if you're self-employed or run a small business as, say, an S-corp or partnership. It's a really powerful tool.
Not just some accounting detail. It's fundamental to how taxes meet business reality.
So our mission here today is to really unpack this NOL thing. What is it, really? How do you figure out if you even have one and how much it is? Because, spoiler, it involves some specific math.
Definitely some adjustments involved.
Then what can you do with it? That's where carrying losses to other years comes in forwards, sometimes historically backwards. We'll hit the current rules, the old rules, the limits.
And we're drawing on good sources here. IRS, Pub 536, workbooks, FAQs, expert analysis from places like a tax foundation, NOLO.
We want to give you a clear, solid understanding. Okay, let's get into it.
All right, first things first, what is an NOL? Because, importantly, it's not just any year where your business expenses were more than your income.
Oh, so having a loss on my tax return doesn't automatically mean I have an NOL.
Exactly. That bottom line loss is where you start, definitely. But an NOL is a specific tax calculation. It's the amount of that loss the tax code says you can actually use to offset income in other years. And getting to that number, that requires adjustments.
Adjustments. Okay, so you're filtering the loss somehow.
You can think of it like that. The idea is to isolate the true loss from your business operations. So you have to add back or adjust certain things that might have made your overall loss bigger, but aren't considered part of the net operating loss that you can carry over.
Got it. A specific calculated business loss figure. And who needs to worry about this? You said individuals, self-employed.
Yes, individuals are key. Estates and trusts, too. And critically, anyone self-employed. If you're a sole proprietor, an independent contractor filing a Schedule C.
That's your profit or loss from business form, right?
The net income, or crucially, net loss from that Schedule C, flows right onto your personal form 1040. If that Schedule C shows a loss, that's usually the main ingredient in figuring out if you have an NOL on your personal return.
So my side hustle loses money, it hits my 1040, and these NOL rules apply directly to me.
Directly to you. And it's basically the same idea if you own part of an S corporation or a partnership. These are pass-through entities.
Meaning the profit or loss passes through to the owners?
Exactly. The income or loss generally doesn't get taxed at the S-corp or partnership level for federal income tax. It flows through to you, the owner, on a Schedule K-1. If that K-1 shows a loss, it lands on your personal return and can contribute to an NOL, just like a Schedule C loss.
Okay, so sole proprietors, partners, S-corp shareholders, they're all potentially dealing with NOLs on their personal returns. Is there any common structure where it works differently?
Yes, C corporations. The NOLO source points this out clearly. A C corp is its own separate taxpayer. If it has a net operating loss, the C corp calculates and uses that loss itself at the corporate level.
Ah, so it doesn't pass through to the shareholders' 1040s.
Correct. Shareholders in a C corp generally don't see the company's NOL on their personal return.
Okay, so our main focus here is individual self-employed folks, pass-through owners, and their personal taxes.
Got it. Before we get into the calculation weeds, let's step back. Why? Why does the tax code even have this NOL concept? What's the big idea behind it? The Tax Foundation had some interesting points on this. Yeah, if you think about the goals of the tax system, fairness, efficiency, supporting the economy, NOLs make a lot of sense. The most obvious benefit for you is just tax relief. Plain and simple.
Reducing my taxes in good years because I had bad years.
Precisely. You take a loss from one year and use it against income in another year, historically maybe carrying it back for a refund, now mostly carrying it forward to cut future tax bills. The core idea is leveling things out.
Which feels fair if your income bounces around, right?
Absolutely. And that hits on a key economic point the tax foundation makes: smoothing business income. Very few businesses have perfectly steady profits. Industries have cycles, startups take time, recessions hit.
Yeah, tell me about it.
Without NOLs, you could pay high taxes in your good years, get zero tax benefit from your loss years, and end up paying way more tax over time than a similar business with the same total profit but steady income.
So NOLs let the tax system look at the bigger picture, like your average income over time.
Exactly. It taxes your average profitability, not just your peaks. It makes the system more neutral.
It feels like that would make it easier to take risks, start something new. If you know a potential early loss won't hit quite so hard tax-wise.
That's a huge point: risk mitigation. Think about startups needing big upfront investment. Or industries like hospitality, R&D, they're sensitive to downturns. They expect losses sometimes.
Right.
Allowing them to carry those losses forward, especially indefinitely like now, reduces the tax penalty on taking that initial risk or weathering a slow period.
Like those examples you mentioned, FedEx, Amazon, even newer ones like Uber, years of losses. Imagine trying to scale like that without NOLs.
And it ties directly into business survival.
Yeah.
Good NOL rules, especially strong carry-forwards, can genuinely help companies survive recessions. That loss carry-forward provides cash flow in later profitable years by reducing taxes.
Cash flow, that could mean keeping people employed versus layoffs.
Exactly. Keeping the doors open versus shutting down. The sources talk about how these rules help businesses recover post-Great Recession, post-COVID. It helps bridge the gap.
You mentioned leveling the playing field, too. That tax foundation example with the different stores really drove that home for me.
Oh, yeah, that's a great illustration. They had, a convenience store with steady profits.
Right, steady Eddie. Then a jewelry store, cyclical, booms and busts.
And a hardware store, startup losses, then growth. Over 10 years, all made the exact same total profit.
Right.
But without NOLs, the jewelry store and the hardware store paid way more tax. Their effective tax rates were like 7% or 8% compared to the convenience store's 5%.
Wow. Just because their income wasn't smooth, that seems unfair.
It is a kind of unfairness, horizontal inequity, they call it. But then you add NOL rules, let them use the losses against the profits. And boom, all three stores end up paying much closer to that 5% rate over the long haul.
So it makes the tax code neutral, regardless of whether your business is steady, cyclical, or a startup.
That's the goal. It's not just a loophole, it's a structural feature trying to make the system align better with how businesses actually work and contribute over time. It supports risk, investment, survival, and fairness.
Okay, the why is clear and pretty compelling, but the how? How do you actually calculate this thing? You said it's not just the bottom line loss. This is where it gets tricky.
This is where you need to pay close attention. Yeah, it gets really specific. The basic idea is you start with your overall loss for the year from your tax return. For individuals, that's usually your negative taxable income after deductions.
Okay, start with the negative number.
Right. Then you have to make these adjustments. The tax code essentially says, okay, we see your loss, but certain things that contributed to it aren't really operating losses for NOL purposes. So you have to add those back.
Add things back to the loss, making the NOL smaller than the total loss.
Often, yes. You're isolating the loss specifically from business operations. Pub 536 and the worksheets guide you through this. It's like filtering out the non-business stuff.
Okay, what kind of stuff gets filtered out? What do you add back?
A big one is non-business deductions exceeding non-business income. Let's break that down.
Please do.
Non-business income is generally passive or personal stuff. Interest income, dividends, alimony you receive, IRA payouts, pensions, taxable Social Security.
Okay, investment income, retirement income.
Right. And non-business deductions are typically your personal deductions, your standard deduction or itemized deductions like medical expenses, state and local taxes, SOL cap aside unless they were directly business related, home mortgage interest, charity donations.
So if my personal itemized deductions, say for mortgage interest and charity, are way higher than my little bit of interest income, I can't use that difference to make my business NOL bigger.
Exactly. That excess personal deduction amount gets added back. The logic is your personal spending shouldn't inflate a business tax benefit you can carry to other years.
Makes sense. What else gets added back or limited?
Non-business capital losses are another one. You can only count those against non-business capital gains when figuring the NOL. Any excess non-business capital loss gets added back. Business capital losses have different rules.
Okay, limit non-business capital losses. Anything else major?
Crucially, you cannot deduct an NOL carryover from another year when calculating the NOL for the current year.
Right, no double dipping or circular calculations.
And for recent years, there are specific deductions you have to add back to. The Section 199A qualified business income deduction, the QBI deduction.
Yeah, the pass-through deduction.
That gets added back. You can't use the QBI deduction to create or increase an NOL. Same idea for the Section 1202 exclusion for gain on qualified small business stock. If you claim that, you add it back for the NOL calc.
So it's really about stripping out personal deductions, investment losses beyond gains, and certain other tax breaks to get down to the core operating loss of the business itself.
That's the essence of it. And getting that distinction right, business versus non-business income and deductions, is absolutely fundamental. The IRS publications have tables with examples.
Like Schedule C income is clearly business. Wages are business income too, technically.
Sure.
Rental income usually is, but...
But rental income brings up passive activity loss rules.
Right. How do those fit in?
Good question. Rental losses are usually business, yes, but they're often passive activities under Section 469 rules. Those rules can limit how much passive loss you can actually deduct in the current year.
Okay.
For NOL purposes, you can only include the amount of passive loss that was allowed under the passive activity rules for that year. Any passive loss that got suspended because of those rules, you can't use that suspended part to create or increase your NOL for the current year.
So step 1 is apply passive loss limits. Step 2 is take the allowed passive loss, if any, and potentially include that in the NOL calculation subject to all the other NOL adjustments.
Precisely. You run it through the passive loss filter first. So the process looks like this. Start with your overall negative taxable income, then use a worksheet like the one conceptually in Pub 536 to systematically add back those items. Excess non-business deductions, excess non-business capital losses, QBI deduction, Section 1202 exclusion, any NOL carryovers from other years. The number you end up with is your net operating loss for the year.
Got it. It's a specific adjusted figure. Okay, painful calculation done. I have my NOL number. Now what? How do I use this thing? This is where carryovers and carrybacks come in. And you said the rules have changed a lot.
A lot. How you use an NOL really depends on when the loss happened. The rules now for NOLs from tax years ending after 2020 are the main game.
And what's the main rule now?
Generally, forward only. For these post-2020 NOLs, you can typically only carry the loss forward to offset income in future tax years. The general ability to carry losses back to get refunds from prior profitable years, that's largely gone for most businesses. Pub 536 flags this right up front.
So my 2023 NOL can only be used in 2024, 2025, 2026, and onwards.
That's the general rule. But here's a big positive change. For NOLs arising in tax years ending after 2017, that carry-forward period is indefinite at the federal level.
Indefinite. So it doesn't expire after 20 years like it used to.
Nope. Federally, you can carry these NOLs forward until they're completely used up, however long that takes. The Tax Foundation highlights this as a major improvement.
Wow. Indefinite is huge for long-term planning.
Yeah.
Are there any carrybacks allowed now? Any exceptions?
Yes. One main one mentioned in Pub 536. Certain farming businesses can still elect a 2-year carryback for their losses. But for most other businesses, federally, carrybacks are off the table for recent NOLs.
What about that weird period in between? After the 2017 TCJA changes, but before these latest rules, didn't the CARES Act bring back carrybacks temporarily?
Yes, good point. That's crucial if you had a loss a few years back. The CARES Act created a temporary window for NOLs from tax years starting in 2018, 2019, or 2020.
Okay.
There was a temporary rule allowing a 5-year carryback. So a 2020 NOL could potentially have gone back to 2015.
Ah, okay. And did you have a choice? Could you skip the carryback?
Yes, the IRS FAQs mention this. For those 2018-2020 NOLs, you could elect to waive the entire 5-year carryback and just carry it forward. Or there was a more specific election to waive carryback only to certain prior years affected by a repatriation tax rule, Section 965 years. You had to attach a statement to your return making that election.
Okay, so the rule really hinges on the year of the loss.
Yeah.
Post-2020, forward indefinitely. Generally no carryback except farms. 2018, 2020, temporary 5-year carryback was an option, or elect forward only. Pre-2018, older rules, usually 2-year back, 20-year forward.
You got it. Knowing the NOL year is step 1.
Now, this is where my head starts to spin a little. The states, The tax foundation piece made it sound like a total patchwork quilt out there. States don't just follow the federal rules.
Often, no. This is a really critical point. Most states start with federal income figures, sure, but then many apply their own distinct rules for NOLs. How much you can carry forward, if you can carry back, how much you can deduct each year. It varies wildly.
How much variation are we talking? Like minor tweaks or big differences?
Big differences. According to that tax foundation data from a couple years back, you had about 19 states plus D.C. that mostly conform to federal rules indefinite carry forward. The 80% annual limit we'll discuss, no general carryback, that's relatively simple.
Okay, conformity states are easier. What about the rest?
Then you had a group, around 13 states, that didn't conform but had arguably better rules in some ways. They stuck with a 20-year carry-forward limit, which is less than indefinite. But they generally had no cap on how much income you could offset each year. If your NOL was big enough, you could wipe out 100% of your state taxable income that year.
Interesting trade-off. Shorter time limit, but potentially bigger bang each year.
Exactly. Then there's another group, 12 states the source identified, with carry-forward periods even shorter than 20 years.
Shorter than 20, like what?
Examples given were 15 years in places like Alabama, Minnesota, North Carolina, Illinois at 12 years, Michigan, Montana, New Hampshire, Vermont down to 10 years, Arkansas at 8, and Rhode Island was listed at only 5 years.
That's incredibly short. If you're a startup that takes 6 years to get profitable, a 5-year carry forward is useless.
It's a major disadvantage. The tax foundation argues these short periods really hurt startups and cyclical businesses. And some states add other caps. Pennsylvania limiting the total loss carried forward, New Hampshire capping the annual deduction amount.
And California even temporarily suspended them entirely at one point.
Yeah, during a budget crunch, they temporarily hit pause on NOL deductions for certain taxpayers. Shows how state rules can fluctuate based on fiscal pressure, sometimes undermining the whole point of NOLs as stabilizers.
And then states with gross receipts taxes.
Right. Nevada, Ohio, Texas, Washington, since they tax revenue, not profit, NOLs generally just don't apply there.
Wow. Okay. So you absolutely have to know your federal and your state NOL rules, and they could be completely different. That adds a huge layer of complexity.
It really does. State tax planning for NOLs is critical.
Okay, let's go back to the federal rules for using the NOL. We know it's mostly carry forward now indefinitely, but you mentioned a limitation on how much you can deduct each year, that 80% rule.
Yes, another key piece, especially for NOLs from 2018 onwards. This rule generally applies for tax years beginning after December 31st, 2020. There's a limit on the total NOL deduction you can take in any single profitable year.
How does the 80% limit work?
Okay, it's a bit layered. First, any NOLs you're carrying forward from before 2018, those aren't subject to this 80% limit. You can generally use those older NOLs to offset 100% of your income until they're gone.
Okay, pre-2018 NOLs get used first, no limit. Then what?
Then, for the NOLs you're carrying forward from tax years after 2017, the amount you can deduct is limited. It's the lesser of two things. Either A, the total amount of those post-2017 NOLs you have available to carry into the year, or B, 80% of your taxable income for the current year.
80% of taxable income. You said figured with certain modifications earlier.
Right. Good catch. You calculate that 80% limit based on your taxable income before you take the NOL deduction itself, and also before taking deductions like the QBI deduction. It's 80% of that modified taxable income figure.
So practically speaking, even if I have a massive NOL carry forward from, say, 2021, I probably can't use it to wipe out my entire taxable income in 2024.
Generally, no. Because of that 80% limit on the post-2017 NOL deduction, you'll likely still have at least 20% of that modified taxable income left as taxable income. The part of the NOL you couldn't deduct because of the limit, that just carries forward to the next year.
Okay, so the 80% rule slows down how quickly you benefit from newer NOLs. Is there another limit I need to know about? Something about large losses in the current year? The excess business loss thing?
Yes. This is another layer, also part of recent tax changes, currently applying through tax year 2028. It hits non-corporate taxpayers, so individuals, estates, trusts, including losses flowing from pass-throughs.
Okay, what does this limit do?
It puts a cap on how much total net business loss you can deduct in the current year. If your combined net losses from all your trades or businesses are more than a certain threshold amount, it's indexed yearly. For 2023, it was $289,000 single, $578,000 married filing jointly.
Okay, pretty high thresholds.
Yes, but if your net business losses exceed that threshold, the excess amount, the part over the limit, is disallowed as a deduction this year.
Disallowed completely? Or does it become something else?
It becomes something else. That disallowed excess business loss is automatically treated as an NOL carry forward to the next year.
Ah, so it forces a big chunk as a very large current year loss into becoming an NOL for future use rather than letting you use it all right now against, say, investment income or spouse's wages.
Exactly. It limits the ability of massive business losses to zero out all other types of income in the current year. You figure this out on Form 461, limitation on business losses. It's like a gatekeeper before you even get to the regular NOL rules for carrying forward.
Okay, another complexity layer. What about debt forgiveness? If a struggling business gets debt canceled, how does that interact with NOLs? Form 982 was mentioned.
Yes, this is really important for businesses in distress. Normally, canceled debt is taxable income, but there are exceptions if the debt is canceled in bankruptcy or while you're insolvent, more debts than assets, or for certain farm or real estate business debt. In those cases, you can often exclude the canceled debt from your income.
Which sounds great, tax-free income.
It is great, but there's usually a catch. When you exclude canceled debt income, the tax code generally requires you to reduce certain tax attributes. You have basically favorable tax items on your books. And guess what's often first on the list?
Let me guess.
NOLs.
You got it. Your NOL carry forwards are typically the first or among the first tax attributes that have to be reduced by the amount of debt income you excluded. You report this reduction on Form 982. So getting debt relief might mean giving up some or all of your NOLs.
Wow, so one form of tax relief can cancel out another. That's critical to know. Any other quick complexities?
Yeah.
Community property states using multiple NOLs.
Right. The sources mention special rules for figuring each spouse's share of an NOL on a joint return in community property states. You'd need to look at state law and specific IRS rulings. And yes, if you have NOLs from several different years, you have to use them up in chronological order. Apply the oldest NOL first until it's gone, then move to the next oldest.
Okay. Calculate the specific NOL number. Know the carryover rules, mostly forwards now indefinitely. Watch the 80% annual limit, the excess business loss limit for big current losses. Be aware of debt forgiveness impacts. Use oldest NOLs first. Definitely not simple. So how do you actually claim the deduction once you've figured all this out?
Okay, claiming it. Depends if you're carrying forward or, in rare cases now, carrying back.
Let's do carry forward first, since that's the main way now.
Carrying forward is relatively straightforward. In the profitable year where you're using the NOL, you claim it as a deduction. For individuals on Form 1040, it goes on Schedule 1, Additional Income and Adjustments to Income. Line 8A on recent forms. You enter it as a negative number, and it reduces your adjusted gross income, AGI.
Okay, just a line item reducing AGI. Simple enough. What if I can carry back? Say I'm that farmer with the 2-year option, or I had a 2019 NOL and didn't waive the carryback. How do I get that refund from a prior year?
Two main ways to claim a carryback refund. Option 1 is Form 1045, application for tentative refund. This is generally the faster way to get the cash. The IRS is supposed to process these relatively quickly, usually within 90 days.
Faster sounds good. What's the catch?
The deadline is tight. You generally have to file Form 1045 within just 1 year after the end of the year the NOL occurred. And you use one Form 1045 to claim the refund for all the carryback years affected by that single NOL.
Okay, Form 1045. Quick cash, short fuse. What's the other way?
Option 2 is Form 1040X, amended U.S. individual income tax return. You file an amended return for the prior year or years you're carrying loss back to.
Amending the old return. How's the timing on that?
You generally have more time. The deadline is usually 3 years from the due date, with extensions of the tax return for the year the NOL happened. So more time to file. The downside, you have to file a separate 1040X for each prior year you're amending. And amended returns can take longer for the IRS to process than a 1045.
Got it. 1040X. More time, maybe slower processing, potentially more paperwork, if hitting multiple years. Do I need to show my math for the NOL itself when I file these?
Absolutely. Whichever form you use for the carryback 1045 or 1040X, you need to attach schedules showing how you calculated the NOL in the loss year, like Schedule A of Form 1045, and how you calculated the deduction and any remaining carryover in the carryback year, like Schedule B of Form 1045.
Now, when you carry back an NOL, it's not just subtracting the loss from the old income, right?
Yep.
The sources said you have to refigure your tax for that prior year. Why?
This is super important and easy to miss. Carrying back an NOL lowers your adjusted gross income, AGI, for that prior year. And so many other things on your tax return depend on your AGI. Deductions, credits, limitations. They might change now that your AGI is lower, so you have to essentially redo parts of that prior year's return based on the new lower AGI.
What kinds of things typically get refigured?
Lots. The Form 1045 instructions list them. Things like IRA deduction limits, student loan interest deduction, maybe taxable Social Security benefits change. Certain itemized deductions that have AGI thresholds or limits need refiguring medical expenses, the floor percentage, maybe casualty losses. Even some credits might change if they're based on AGI or tax liability, like the earned income credit.
So applying the NOL can suddenly make me eligible for deductions or credits I didn't qualify for before, or change the amount.
Exactly. Or decrease limitations. You have to go back and recalculate those items using the AGI after the NOL deduction.
Are there things you don't refigure?
Yes, some things are specifically excluded from refiguring. Charitable contribution deductions, for instance, the amount you deducted generally stays the same, though the carryover might change. And importantly, you don't refigure your self-employment tax based on the NOL carryback. That's based on your self-employment earnings, not the post-NOL AGI. Same for the additional Medicare tax.
Okay, so it's a detailed recalculation, almost like doing that old tax return over again in some ways. Meticulous work.
It really is. And one more calculation step: tracking the carryover. After you use part of an NOL in a carryback or carry forward year, you need to figure out how much is left for the next year.
How does that work?
You need to calculate something called modified taxable income for the year you just used the NOL in. It's similar to the concept for the 80% limit, but a bit different. You start with taxable income for the year you applied the NOL, and then you add back certain things again. Importantly, you add back the NOL deduction you just took in that year, the QBI deduction, and make capital loss adjustments.
Okay, calculate this modified taxable income for the year the NOL was used.
Yeah.
Then what?
Then the amount of NOL you carry over to the next year is your original NOL amount minus that modified taxable income you just calculated. Basically, the modified taxable income shows how much of the NOL got absorbed or used up in that year. Whatever's left over carries forward. You repeat this each year until the NOL is gone.
Got it. It's a running tally, reducing the NOL balance year by year based on how much modified income it offsets.
Precisely. Keeps track of the remaining benefit.
Okay, let's pull back again. We've gone through the what, why, how to calculate, how to use, the limits, the claiming. Thinking about those broader impacts again from the tax foundation, why does mastering all this complexity matter beyond just my own tax bill?
Well, connecting it back, the existence of these NOL rules, even with their complexity, serves really fundamental economic purposes. They're seen as pro-growth. They're not just giveaways. They're designed to reflect the reality of business cycles.
How does letting me deduct losses help the whole economy grow?
By smoothing income, like in that store example, it makes the tax system fairer and more predictable over the long term. That stability encourages businesses to make long-term investments, to hire people, knowing that a bad year won't be unduly punished by the tax code.
It helps them ride out the storms.
Exactly. The sources stress how crucial this is for surviving downturns. Businesses that survive recessions because NOLs help their cash flow are the ones that retain jobs, keep capital intact, and can ramp up quickly in the recovery. It speeds things up for everyone.
And that neutrality idea, treating different business models fairly.
Hugely important. Robust NOLs help ensure the tax code doesn't accidentally favor steady profit businesses over innovative startups or cyclical industries. That fosters diversity in the economy. That hardware store and jewelry store shouldn't pay more tax over a decade just because their profit path was bumpy, right? NOLs help fix that.
And the flip side is states with weak NOL rules actually hurt themselves.
That's the argument. The Tax Foundation contends that states with short carry-forward periods or tight caps make themselves less attractive for investment, especially for startups and capital-intensive industries. Their NOL policy becomes a competitive disadvantage.
So these technical rules really shape state economies. Did the source suggest how states could do better?
Yeah, they offered policy options based on their analysis. Things like conforming to the federal standard indefinite carry-forward 80% cap, or adopting the old 20-year carry-forward but without an annual cap. They even suggested states could consider bringing back carrybacks, arguing they provide cash flow during recessions, even though that's not the current federal approach generally.
Interesting. So it's clear NOLs are fundamental, complex, but really important for businesses and the economy. Given all this detail, getting help seems wise.
Absolutely. And there are resources. IRS.gov is Ground Zero, Pub 536, the forms, 1How45, 1040X, 461, 982, instructions, FAQs, often in multiple languages too.
Any online tools from the IRS?
Yes, the interactive tax assistant can help with questions. You can access your online account. There's the Where's My Amended Return tool for tracking a 1040X. Are online too.
What about free help for folks who qualify?
Definitely. VITA volunteer income tax assistance for lower income, disabled, or limited English-speaking taxpayers. MilTax for military members and veterans. And IRS free file software or fillable forms are options too, depending on income.
And if you need to pay a professional.
The key is finding a qualified one, especially for something like NOLs. Look for someone with credentials and experience. IRS.gov has tips for choosing a preparer. Remember, even if you pay someone, you are ultimately responsible for your return's accuracy.
Good reminder. What if you run into problems with the IRS? Disputes, things you can't resolve.
You can try Taxpayer Assistance Centers, TACs, for in-person help by appointment. They have phone interpretation services in hundreds of languages and accessibility options. But if you're really stuck or feel your rights aren't being respected, there's the Taxpayer Advocate Service, TAS.
They're independent within the IRS.
Yes, TAS is there to help resolve problems and protect taxpayer rights under the Taxpayer Bill of Rights. They have local advocates.
And for low-income taxpayers specifically facing disputes.
There are low-income taxpayer clinics, LITCs. They're independent of the IRS and TAS and offer free or low-cost help with audits, appeals, collections, and understanding your rights, often multilingual too.
Okay, so lots of avenues for help, which is good given the topic. It seems navigating NOLs takes precision, maybe professional help, but the potential tax relief is significant.
It's definitely an area where knowing the rules or getting good advice can really pay off for a business's bottom line and resilience.
So wrapping this up, what's the big takeaway for you, the listener, running your business or side hustle?
I think it's that a loss year doesn't have to be just a loss. The net operating loss rules are a complex but powerful feature of the tax system designed to provide real relief and support businesses through thick and thin.
Understanding how to calculate that specific NOL number. Knowing the carry-forward rules indefinite federally now. Being aware of the 80% annual deduction limit, the excess business loss cap, those state variations. It's all crucial for smart tax planning and managing your business financially over time.
It really encourages thinking beyond just one tax year. It's about the long game.
And maybe one final thought, stepping back again. This whole deep dive into NOLs, it shows a fascinating tension, doesn't it? The government needs revenue, obviously. But these rules, complex as they are, seem like a deliberate choice not to maximize revenue in the short term.
Right, by allowing businesses to smooth income, carry losses, weather storms. The system is implicitly encouraging risk-taking, innovation, the kind of activity that builds a stronger, more diverse economy down the road.
It's like an investment by the tax system itself. Forgo some tax today from a struggling business. Maybe get more tax from a thriving, larger business tomorrow. A complex balance between short-term collection and long-term growth.
Exactly. It shows tax policy isn't just about raising money. It's also about shaping the economic environment.
So what does that balance tell you about the relationship between taxes and the kind of economy we want? Definitely something to chew on as you manage your own business finances, whether you're in the red or the black right now.